Everyone. In this video, we're going to be talking about index funds. An index fund is a type of investment fund that tracks a market index. Instead of investing in just one company, an index fund invests in a large group of companies. The goal is not to beat the market, but simply to match the performance of the index it follows. Because of their simplicity and diversification, index funds have become one of the most popular investment choices for long term investors. Before we understand more about index funds, we first need to understand what an index is. Think of an index as a basket of stocks used to measure the performance of a section of the market. For example, the S&P 500 contains about 500 of the largest companies in the US. If most of those companies perform well, the index rises. If many of them perform poorly, the index falls. An index simply helps us track how a group of companies is doing. Let's see how an index fund works in practice. Imagine you want to invest in companies like Apple, Microsoft, Amazon, Nvidia, and hundreds of other major businesses. Buying each stock individually would take money and research. Instead, you can buy an index fund that already owns all these companies. With a single investment, you gain exposure to hundreds of stocks at once. This provides diversification and reduces the risk of relying on the success of just one company. One of the biggest differences between index funds and individual stocks is diversification. When you buy an individual stock, your investment heavily depends on the performance of that one company. If the company performs well, you benefit. If it struggles, your investment can decline significantly. An index fund spreads your investment across many companies, reducing the impact of any single company. While individual stocks may offer higher potential returns, they also come with higher risk and usually require more research and monitoring. Although index funds are diversified, they are not guaranteed investments. Their value can still rise and fall with the overall market. For example, during a market downturn, an S&P 500 index will likely decline because many of the companies within the index are declining as well. However, index funds are generally designed for long term investing, where investors can benefit from the overall growth of the market over many years. To summarize, an index fund is a simple way to invest in a large group of companies through a single investment. By tracking a market index funds provide diversification, reduce the need for stock picking, and offer exposure to the broader market. While they are not risk free, they become one of the most popular tools for long term investing because of their simplicity and effectiveness. Thank you.